Hello and welcome to Emmy's Quick Investor's Insight into the UK SRS S2 climate-related disclosure standards, where we touch on the core concepts of these regulations. This audio series supports our suite of regulatory guides available on our website. Let's take a look.
So today we're getting into the UK's new sustainability reporting standards, specifically S2. This is basically the UK's own take on the global ISSB standard, IFRS S2.
That's right. Think of it as the UK trying to build a really solid, reliable backbone for all climate reporting going forward.
And why should investors be paying attention to this right now? I mean, mandatory dates haven't even been set yet.
Well, it's all about the direction of travel. The final drafts came out in June 2025, and that really signals that voluntary adoption is expected very soon, probably late 2025.
Okay.
You're seeing this huge convergence across UK regulators. We're talking the FCA, HM Treasury, DBT. They're all aligning. So this standardized data is going to become the market expectation really fast. So even if the companies in your portfolio aren't mandated yet, they're getting ready for it. And for asset managers, for banks, this makes them immediate, users of this data, right?
Immediate users, exactly. It's a way to get to that comparability, to get to truly decision-useful climate metrics much faster.
Okay, so let's break it down. What do companies actually have to report? You mentioned it's built around 4 pillars.
Yes, the familiar 4 pillars, which is good because it aligns internationally. You've got governance, strategy, risk management, and then metrics and targets.
Let's simplify those. For an investor, what's the key bit of information they should be looking for in each one?
Okay, so governance is all about accountability. Who on the board is actually responsible for climate risk? And crucially, is it linked to their pay?
Right. Is there any skin in the game?
Exactly. Then strategy is about looking ahead. It forces companies to assess how resilient their business model is against climate threats, but also opportunities. And they have to do that across the short, medium, and long term.
That forward-looking piece is so critical. What about the other 2?
So risk management is about embedding these risks. We're talking physical risks like floods and transition risks like a carbon tax, embedding them right into the company's main enterprise risk framework. It's not a separate thing anymore.
It's just part of doing business.
It has to be. And then finally, metrics and targets. This is where you find the hard numbers. Scope 1, 2, and importantly, Scope 3 emissions, and also the quantified financial effects of climate risk.
That quantification part sounds huge. You mean things like potential asset impairments?
Precisely. That directly impacts how you value a company. And there are other critical details for investors in there. Scenario analysis, for example, is non-negotiable now.
What does that involve?
Companies have to test their strategy against at least 2 climate scenarios, and one of them must be a 1.5-degree pathway. It gives you, the investor, a really robust data point to stress test your own portfolio.
And what about transition plans? I hear a lot about those.
Yes, companies have to disclose their transition plans, and you can look at things like CapEx alignment. Are they actually putting money behind their climate promises? It's a huge test of credibility.
And for financial institutions themselves, that Scope 3 disclosure, that must be fundamental.
Absolutely. The disclosure of financed emissions, that's category 15, is, it's critical. It's the carbon footprint of what you're lending to or investing in. It's how you measure your own portfolio's exposure.
Of course, all of this hinges on data quality. How do investors know what they can trust, especially early on?
That's a great question. Look, assurance is where this is all heading, even if it's not mandatory from day one. You do need to watch for some transitional reliefs, like a phase-in for Scope 3 reporting in the first year.
So what's the key?
Transparency. If a company is really clear about its assumptions and its estimates, then you can judge the quality for yourself. Remember, these aren't just reports for compliance. They're direct inputs into your risk models, your valuation, your stewardship.
So, boiling it all down, what should investors be doing right now to get ready? What are the first steps?
I'd say 3 things. First, start identifying which companies in your portfolio are likely to adopt SRS S2, even voluntarily.
Okay.
Second, start integrating this into your engagement. Push for that high-quality, assurance-ready data. And third, get your own systems ready. You need to be able to ingest and actually analyze this new standardized data as it starts to flow.
Which is where something like Emmy's Carbon Diagnostics can really help. It's built to operationalize this, giving you those finance emissions calculations and transition risk analytics in an assurance-ready way.
Right. It helps translate what can be very complex carbon metrics into clear financial impact. It gives you that clarity in a market that's changing really, really quickly.
Thanks for listening to Emmy's Investor Regulation Insight. EMI Climate Risk, built for investors, delivers financed emissions data, transition risk analytics, and climate-aligned portfolio diagnostics across all major asset classes. Our models translate carbon into financial impact, giving investors clarity and confidence in a fast-moving regulatory and market environment. To explore more regulation resources, guides, and tools, visit me.io. Join us next time as we unpack climate finance.